Last time around, we reviewed the key trends in financial markets for 2021. This time, we're going to dust off the crystal ball, dusty and cracked as it may be, and look ahead to 2022 and beyond. Now, no one, not even central bankers, know what's coming next, and whether inflation, stagflation, or deflation will result from the combination of the pandemic, lockdowns and supply chain chaos on one side, and massive amounts of fiscal and monetary stimulus designed to boost demand on the other. But keeping an eye on the next 5 trends that we're going to discuss may help you, investors, sense which way the wind's blowing so you can try and obtain the best possible risk-adjusted returns from your portfolios once you've done your research. The first trend is the battle between value and growth. For want of a better turn of phrase, growth has outperformed value for the thick end of a decade, thanks to the prevailing low growth, low interest rate, low inflation fog which has enveloped the globe. If this environment persists, firms which are seen as capable of providing secular trends increases in sales, profits and cash flows, or maybe even just the first one, could remain highly prized. If the environment changes and inflation and strong nominal GDP growth take over, then there would be no reason to pay high multiples for secular growth when cyclical growth, or value, will be available at much lower valuations. Industrials and banks, for example, could then lead the charge. One way of measuring whether this shift in leadership is happening or not is by comparing the performance of the Invesco QQQ Trust, which has got the ticker QQQ on the New York Stock Exchange and it's packed with growth stocks, against the iShares Russell 2000 Value ETF, which comes with the ticker IWN on the New York Stock Exchange. Now, if the line goes up, value is doing better and vice versa. Value's latest attempt for glory is petering out a little, perhaps owing to worries over COVID variants and the effects of higher prices and clogged supply chains on economic activity. The second trend, well, that's the battle between emerging and developed equity markets. Emerging equities dominated for the first decade of this millennium, but developed ones have subsequently ruled the roost. Demographics, debt to GDP ratios, and the possible trend towards onshoring in the West are all factors here. But it seems reasonable to expect export-driven emerging markets to fare relatively well if global growth rates pick up. Any attempts by China to loosen monetary policy and stoke growth could also help emerging markets, where the Shanghai market has a very big weighting and therefore a very big influence. The third trend is the battle between real and paper assets. Looking at the relative performance of the Bloomberg Commodity and the FTSE All-World Equity Indices, commodities and real assets outperformed during 2000 to 2010, but equities and paper assets have dominated since. Again, this trend could be reasonably expected to continue if we stay stuck in a low growth, low rate, low inflation world. But if inflation or maybe stagflation take hold, real assets could come to the fore for 3 reasons. They could be stores of value. Central banks may keep printing money, but they can't print oil, gold or property. And investment in new resources finds is dwindling thanks to pressure from politicians, investors and the public alike, amongst environmental concerns. The fourth trend is the battle between gold and Bitcoin. The subject of stores of value and haven assets can lead to heated debate. It's hard to argue that Bitcoin's a store of value given the wild swings of the last 5 years in its price, and the same accusation can frankly be levelled at gold. Neither produces a yield either, and both trade way above their marginal cost of production, as my colleague Kevin Doran from AJBL Investments never ever tires of telling me, or frankly anybody else who will listen. Yet rampant deficit creation by governments and money printing by central banks, in an attempt to effectively monetize and fund the extra debt, do persuade some to make an investment case for one or the other, although rarely both. Gold did next to nothing and underperformed Bitcoin again in 2021. But its role as a haven during times of great uncertainty or stress, when it looks like the authorities are not in control, could come into play if inflation gallops higher. The gold price relative to Bitcoin makes for an interesting chart, but the metal may remain dormant if inflation fizzles out. And the fifth trend is volatility, or at least its fairly noticeable absence for much of the past 10 years. After a brief foray up to 30 on news of the Omicron variant, the VIX or Fear Index, which gauges future volatility in the US stock market, is trading pretty much in line with its long-run average of 19 as I sit here. Now, if markets retain their faith in central bank control, inflation remains subdued and the variant passes by, fear will likely further dissipate. But if inflation takes hold and confidence in policymakers ebbs, volatility may just make its long-awaited comeback. Now, that's not necessarily a bad thing anyway. Volatility can provide you with a chance to sell expensively and buy cheaply if you can keep your head while all around you are losing theirs. But it also requires patience and nerve to come through volatility, and ensuring you have a balanced portfolio that can provide upside potential as well as downside protection is one way of combating any spike in volatility and help you sleep more soundly at night. I hope that you and your families are all in good health and good spirits. May I wish you all the very best for the festive season and a prosperous 2022. Thank you for watching, and I look forward to seeing you all again in the new year.